Hello, Abby Goffredo here with the Mortgage Mommy Minute. The presentation today is a summary of Barry Habib's insight presented on March 26th, courtesy of MBA's Highway. How do mortgages work? We have an originator, such as myself, who meets the client and gets the mortgage closed. Then the loan goes to the servicer, which may or may not be the same company that originated the loan. The borrower submits the payment to the servicer. However, the servicer does not own the loan. They're simply maintaining the loan. This means that they are collecting payments, they are forwarding that money to the investors, they're paying taxes, insurance, and answering questions, etc. While they maintain or service the loan, the asset itself is sold to an aggregator or directly to a government agency. The loan then gets placed inside a large bundle, which is put in the hands of an investment banker. The investment banker converts those loans into a mortgage-backed security that can be sold to the public. This shows up in different investments like mutual funds, insurance plans, and retirement accounts. Let's talk about the servicer. They pay 1% upfront for the opportunity to service the loan. Their break-even point is about 3 years, and the longer the loan remains in the books, the more money they make. However, when the interest rates dropped drastically, there was an influx of rapid refinancing, and many of those loans had not been serviced for 3 years yet, which caused the servicers to lose money. With the virtual shutdown of the economy due to COVID-19, there has been an unprecedented number of job losses. Some are having difficulty making their mortgage payments. Many people don't know this, but servicers must make the payment to the investors regardless if they receive payment or not. Normally, there is plenty of cushion, but an extreme level of delinquency creates an unmanageable position. Government, in an effort to help, granted forbearance, which means the payments can be postponed. But remember, servicers must still make the payments. Accelerated payments due to refinances and the uncertainty of repayment has decreased the lender's overall net worth, which reduces their capacity to lend. In addition, the Fed's lowering the rates has also affected the lender's ability to lock loans. The full explanation is more complicated, but here's a simplified version. If rates were to rise, lenders are obligated to buy down their rate to the amount that it was promised on the lock agreement. Again, losing money. So while the Feds think that they are stimulating lending, in reality it's causing the opposite effect. Lenders need to clear the pipelines, but social distancing is delaying the process. On top of everything else, loans that are about to close require verification of employment. And with millions of individuals losing their jobs, those mortgages are unable to fund, leaving the lenders with additional losses. In conclusion, lenders have no choice but to slow down the influx of transactions by increasing the mortgage rates and reducing the amount of time they are willing to lock the loans. Stay tuned to the next video to learn what we at Equity Prime Mortgage are doing to alleviate the situation.